Good evening, everyone. I am Rashi Bansal from PGTM Finance Analytics FA2. So, today I will be presenting on microfinance and sustainability in the Indian context. Microfinance refers to providing small loans and financial services to low-income individuals who do not have access to traditional banking. In India, it plays a crucial role in financial inclusion. However, this presentation is not only about growth, it focuses on whether microfinance is sustainable, meaning does it improve borrower welfare while remaining financially stable in the long term. So we will examine both the positive impact and the key challenges. So first talk about a catalyst for inclusion. India has more than 30 million active borrowers and 95% of them are women. Around 80% belong to rural areas. This shows that microfinance strongly supports women empowerment and rural development. The system is built on self-help groups, SHG, and joint liability group. According to industry data, the outstanding portfolio is around Rs 7 lakh crore. Microfinance enables access to livelihoods, healthcare, education, and entrepreneurship for underserved communities, so it acts as a bridge between financial exclusion and opportunity. Now talking about the promise, empowerment through the microfinance. Microfinance help bridge the gap between irregular income and formal credit. Most rural household does not have fixed salary or collateral. Microfinance align repayment schedule with their cash flow cycles. Loans are mainly used for productive purpose like livestock, small shops, agriculture stocks, tools, and micro businesses. This increased income generating capacity. The sector has also adopted digital innovations such as Aadhaar-based KYC and UPI payment, improving transparency and efficiency. So access to credit becomes empowerment when it improves livelihood. Now talking about the critical challenge, debt distress and independentness. Despite growth, there are serious challenges. Non-performing assets have doubled from 0.9% to 1.9% within 1 year. This indicates rising repayment stress. Around 6% of borrowers take loans from 4 or more lenders, increasing over indebtedness risk. In extreme cases, borrowers delay medical treatment or withdraw children from school to meet repayment obligations. This shows that financial stress can harm long-term welfare. So growth without safeguard can create social risk. Now talking about the Growth versus Welfare Economic Survey 2025 to 2026. The economic survey highlights a key tension between growth and welfare. Private investors often prioritize rapid expansion, higher valuation, and profitable exits. However, the survey recommends linking investor exits to social impact metrics, not just financial performance. Instead of measuring only loan size and borrower numbers, we should measure household income stability, education outcome, and resilience. This shift focus from scale-based growth to meaningful impact. Now talking about the regulatory and industry responses. To manage these risks, regulatory have introduced safeguards. The RBI and industry bodies limit borrowers to a maximum of 3 lenders and cap total debt at Rs 1.5 lakh. There is a stronger emphasis on responsible lending, better credit assessment, and customer protection norms. There are also calls for improved distress monitoring system and stronger supervision. These measures aims to balance inclusion with protection. Now talking about the strategy, balancing mission and financial viability. For long-term sustainability, MFIs must balance social mission with financial stability. They diversify funding through equity, debt, and securitization. Digital operation improve efficiency and reduce cost. Capacity building of borrowers ensures better repayment ability and business growth. However, challenges such as regulatory constraint and economic downturn still test resilience. Now talking about the road ahead, aligning impact with growth. The future of microfinances lies in aligning impact with growth. Investor exits should depend on evidence of sustained welfare improvement. The sector must evolve from growth-driven to impact-driven models. India's digital infrastructure, Aadhaar, UPI, and account aggregators system provides a strong foundation to build a scalable and accountable ecosystem. This is once in a generation opportunity. Talking about the conclusion part and talking about the aligning pillars of sustainable development. So microfinances remain sustainable for inclusion growth and poverty alleviation in Indian rural and unreserved communities. Regulators, investors and MFIs must have to build resilient equitable microfinance ecosystem.